Welcome to the Deep Dive, the show where we take the market noise, we filter the headlines, and we give you the pure, unadulterated knowledge you need to be truly well-informed. Today, we are wrestling with a macroeconomic contradiction, a real puzzle coming out of India that is forcing, I think, institutional investors and policy wonks alike to ask, what exactly are the stock markets pricing in?
It's the classic disconnect, isn't it? It's sometimes a pretty painful one between those sensational macro headlines announcing this world-beating growth and then the day-to-day trading reality on the ground level.
Exactly. So here is the central tension we're unpacking for you today. On one side, you've got these economic fundamentals just screaming, go.
Right.
India is right now the world's fastest growing large economy. We just saw the gross domestic product, the GDP, for the second quarter of the financial year 2025-26 come in at a massive 8.2%.
And that's a spectacular number.
It is. And that single number points toward a likely full-year GDP growth of around, 7.5%?
Those are just staggering figures, especially when you look at the rest of the world, which is grappling with, sluggish post-pandemic growth and these persistently high interest rates.
Right.
Historically, that level of fundamental structural economic expansion should translate into a soaring equity market. You'd expect double-digit, high-velocity returns.
You would expect that. But if we look at the other side of the ledger, the market reality India's benchmark index, the Nifty 50, is telling a very, very different story.
A much cooler story.
Its one-year return is less than 8%. Now, just think about that for a moment. The underlying economy, the total output, is expanding at 8.2% or more.
Yeah.
But the market, which is supposed to be a forward indicator of that growth, is tracking flat, or in some cases, slightly below the economic performance.
And even that sub-8% return for the Nifty 50 is a bit deceptive, too.
How so?
Well, our sources really highlight that this modest gain is heavily concentrated. It sort of masks the reality that the returns are confined to a very, very narrow basket of large-cap stocks.
Okay, so just a few big names are holding the whole index up.
Exactly. Usually those linked to banking or maybe certain infrastructure plays. The overwhelming majority of mid-cap and small-cap stocks have either fallen, stayed flat, or substantially underperformed the index.
So we're facing this bizarre situation, a hot economy, and structurally, a cool or at least a highly segmented market.
Right.
And that contrast is the paradox defining the Indian investment landscape right now.
It just creates so much confusion for the investor, doesn't it? Are the economic numbers lying, or is the market just being overly cautious? What do you believe?
So our mission today is to cut through that noise. Why is the secondary market, where most of the existing stocks trade, seemingly so unimpressed by these huge global leading growth numbers? We're going to dive into sources detailing a historic, measurable domestic retail investor sell-off, and crucially, we have to look at the technical, economic, and global factors causing this precise disconnect.
And I think we have to establish the analytical framework right away. Because while high GDP growth eventually does translate into market returns, that is the long-term relationship that's solid, the short-term sentiment driving the Nifty's performance right now is dictated by these immediate crucial nuances. We have to explore the sheer magnitude of the domestic shift. The severe global pressures coming from foreign institutional investors or FIIs, and maybe the most important technical factor of all, that critical distinction between nominal versus real GDP.
Right.
The market is reacting to those immediate pressures, not the idealized long-term GDP trajectory.
The initial snapshot from the sources we have, it provides a very dramatic picture of, fear and uncertainty. It's not just that the benchmark market is subdued. It's that domestic retail investors, the very ones who drove the recent market euphoria, are now pulling back aggressively.
And this isn't just cautious waiting. It's a tangible, measurable flight of capital from the secondary market.
So it's not a small reallocation.
Not at all. It's a significant rotation. And the scale of it is the very first piece of evidence we need to dissect to really understand the current market mood.
Okay, so let's unpack this paradoxical environment. I think we should start with the clearest, most measurable evidence of this domestic caution. The retail sell-off data. When we talk about individual investors turning cautious, we actually have hard numbers compiled from the National Stock Exchange that, they quantify the shift.
And these numbers are absolutely vital because they confirm that the caution isn't just, anecdotal. It's not just a feeling.
Right. It's real data.
It represents a significant, almost shocking reversal in sentiment from a demographic, the retail investor, that had for the last 3 years been the relentless stabilizing and driving force in the Indian market. They were absorbing any foreign selling pressure.
Okay, let's quantify the caution then, just to understand the depth of this retreat. Our sources track retail investors, and that includes proprietary traders who buy stocks directly in the secondary market.
Yes.
And due to these lingering concerns over, well, the broadness of economic growth and, crucially, stretched valuations, this group decided to de-risk.
And that decision matrix is key, It's the fear that the easy money has been made.
Okay.
People are basically saying, look, I rode the wave up. Valuations are looking very demanding now, especially when you compare them to global peers. And I'm just not convinced that these high-flying stock prices are justified by the expected earnings across all sectors.
So that encourages a disciplined or sometimes maybe panicked move to the sidelines.
Exactly.
And the staggering result of that collective sentiment. Retail investors sold a net of 19,680 crore rupees.
Which translates to approximately 2.2 billion US dollars.
Wow.
Of local shares on a net basis this quarter, which is ending in early December 2025. That is an enormous amount of capital just leaving the secondary market's active pool of liquidity.
And when we put that number in perspective, the magnitude of the shift, it really stands out.
It does. The key fact for you listening is that this pace makes it the single biggest quarterly retail stock sell-off since the quarter that ended back in June of 2023.
So this is not normal market noise.
Not at all. It's a historic correction in sentiment.
So let's really drill down on that historical context using the flow data that's in our source charts, because this illustrates the dramatic speed of the reversal. We're currently sitting at a net outflow of negative 19,680 crore.
Now, look back at the last major negative flow. That was in June 2023, where we saw a net outflow of minus 25,930 crore. So the current quarter is quickly approaching that level.
Okay.
But what is truly startling is the comparison against the quarters that immediately preceded this cautious phase. This just shows how quickly domestic sentiment can flip from, euphoria to withdrawal.
Exactly. I mean, contrast this with quarters of massive, consistent inflows. In December 2023, retail inflows hit a monumental 46,030 crore.
A huge number.
And even a year later, December 2024, they were still pouring in a robust 40,340 crore.
So we're talking about a swing of over 60,000 crore rupees from the peak quarterly inflow to this recent, very aggressive outflow.
That is an astonishing rapid shift in retail behavior.
It is, moving from 40,000 crore in net inflows to nearly 20,000 crore in net outflows in the span of roughly a year. That is the dramatic, palpable turn in retail sentiment that defines late 2025. It signifies that the local market's most reliable buyer base has, just hit the pause button.
And this retail retreat is happening at a time when the benchmark index itself is struggling to keep pace globally. So despite that hot 8.2% GDP print, the Nifty 50 situation is subdued. It has risen about 10% this year, which I guess in isolation sounds respectable.
It does, but 10% isn't really keeping up with the Joneses, is it?
Right.
If we look across Asia, the Nifty has significantly lagged its peers. For context, we saw indices in China, Taiwan, and South Korea delivering returns well into the teens or even the low 20s during the same period.
So for example,
Well, the KOSPI in South Korea, for instance, driven by those chip and tech heavyweights, saw year-to-date returns approaching 17%. Taiwan's index was even higher.
so that really puts the Nifty's 10% return in sharp relief.
It does.
Because when global money, specifically the FIs, are hunting for high growth tied to market performance, India's index is just underperforming comparable economies. And that just adds to the general sentiment of, missed opportunity and high valuations relative to earnings growth.
And the sources, they pinpoint a structural reason for this lag, the missing catalyst.
Yeah.
While the Nifty is heading for its 10th straight year of gains, it has repeatedly failed to decisively close above its recent all-time high. It just looks exhausted at the top end of its range.
And our sources suggest a very specific reason for this exhaustion: the distinct lack of a significant artificial intelligence thematic influence. Why is this so critical?
Well, because other global benchmarks, especially the US, but also Taiwan and South Korea, have been overwhelmingly boosted by the AI thematic trade.
Right, the AI boom.
The enormous valuation bumps given to semiconductor firms, platform providers, hardware manufacturers, all that has pulled up those indices globally. India's index, while it's structurally strong, it lacks that immediate high growth, high multiple AI component listed directly on the Nifty 50.
I see.
And this deficiency, it contributes directly to its underperformance compared to international peers, which further discourages the retail trader who sees better, faster gains happening elsewhere.
That makes perfect sense. So the macro data is screaming growth.
Yeah.
But the immediate market drivers, the AI thematic, these specific valuation concerns, and now this massive retail pullback are all holding the benchmark back. But this brings us back to the core mystery. Why is 8.2% GDP growth not enough to overcome these immediate pressures? It must be something deeper than just a lack of AI stocks.
It is. It's an issue of sort of economic language. The market isn't doubting the quantity of economic activity. It's doubting the quality of the revenue generated by that activity.
Okay.
And that takes us into the technical distinction that really it explains everything.
All right, so here's where it gets really interesting and a bit technical. But understanding this distinction is the key to unlocking this entire paradox. We need to understand why those massive 8.2% GDP numbers aren't sparking corporate optimism or, translating into stock price momentum.
Yeah.
It comes down to the critical difference between nominal and real GDP.
And this is non-negotiable knowledge for anyone investing in or even just following a rapidly developing economy like India. The market doesn't just care about the sheer volume of goods produced. It cares about the cash flow and the revenues generated. And that's where the nominal figures dictate all the future predictions.
Okay, so let's define these terms clearly, starting with the headline number. When we talk about real GDP, what are we talking about?
Right.
We're talking about the value of economic output after removing the impact of price rises. So, inflation. Economists use what they call an inflation deflator to adjust the current output value down to reflect what the value would be if prices hadn't changed from a base year.
So real GDP is the true measure of productivity. It shows the actual, the real rise in output or economic activity. If real GDP is 8.2%, it means the economy is physically producing 8.2% more goods and services this quarter compared to the same quarter last year.
Yeah, okay, so we strip out price escalation so we can measure the actual real growth.
Precisely.
Then we have nominal GDP. This is the total market value of all those goods and services, but calculated in current rupee terms. At current prices.
Yes, and this number is absolutely vital.
Why?
Because it translates directly into a firm's realities. Their top-line revenues, the prices they can charge, their overall profits, the wages they pay, and even the tax collections the government receives. It is the nominal figure that represents the total market size and current economic activity in pure financial terms.
Okay, now let's bring in the numbers for Q2 FY 25-26. We had that headline 8.2% real GDP. But the critical piece of data is the GDP deflator, that measurement used to adjust for inflation. For this quarter, the deflator was astonishingly low, just 0.5%.
And this low deflator, this is the source of all the market's unease. The relationship is simple. You take the real GDP, 8.2%, you add the deflator, 0.5%, and that gives you the nominal GDP, which came out to 8.7%.
Now, on its face, 8.7% nominal growth still sounds pretty decent.
It does, but the critical context here is history.
Okay.
Our sources highlight that the average GDP deflator over the past 10 years for India is around 5%.
5%. So the current deflator is 10 times lower than the historical average that the market has built all its expectations and valuations upon.
Exactly. This sharp, sudden fall in inflation, as measured by the deflator, is the cause of creased foreheads among policy wonks, as the sources describe it.
I can imagine.
We saw consumer inflation fall to 0.25% in October 2025, and when you strip out volatile components like gold, the deflator calculation resulted in inflation effectively moving into negative territory for certain categories of output.
And that is the problem, because ultra-low inflation, which sounds like great news for consumers.
Yeah, everyone loves low prices.
But it's an absolute nightmare for corporate revenue growth and, by extension, stock markets. Why is that?
Because the stock market looks at nominal GDP growth to make its future predictions about earnings per share, EPS, and future PE ratios. A company's top-line revenue growth is a combination of two things.
Yeah.
Volume growth, that's the real GDP part, and pricing growth, which is the inflation deflator part.
So if inflation is extremely low or near zero, firms just can't raise their prices.
They can't.
They might be selling substantially more volume. That's the 8.2% real GDP we're cheering about. But their total revenue in rupee terms, the nominal number, grows much, much slower than the historical trend.
And the market is priced for high growth. Historically, Indian markets justify their premium valuations, often significantly higher PE ratios than developed markets, by expecting, say, an 8% real GDP and a 5% inflation environment,
Right.
which delivers a projected 13% nominal GDP growth year after year. That's the expectation.
Wait, let me just challenge that for a second. So if the historical expectation is 13% nominal growth to justify these high valuations, and we just printed 8.7% nominal growth, the market is essentially saying that 8.2% real output is not enough to sustain its current pricing structure.
Yeah.
Why is that expectation so fixed?
Because valuation is sticky. If a stock is trading at a PE of 25, that multiple is based on the expectation that future earnings will grow at, let's say, 15% annually. When that nominal growth suddenly drops to 8.7%, the market is immediately forced to compress the PE multiple or see the stock price fall.
Because the expected future stream of earnings has just been downgraded dramatically.
Precisely. The market sees the 8.7% nominal growth and says, whoa, that's a huge deviation from the expected 13% trend line.
Yeah.
That's insufficient to justify our current stretched valuations.
So that provides the strong economic rationale for the broad market hesitation and the specific retail sell-off we identified earlier.
Exactly. The market isn't worried about the pace of work, it's worried about the price of that work. This expectation of subdued revenue growth, driven by these deflationary pressures on the corporate top line, is what's causing the cool down despite the hot real GDP headline.
Right. So the market needs that inflation component to come back to normalize what you call the nominal real corridor.
Yes, that's what it's waiting for.
That is a phenomenal breakdown of the core issue. It shifts the entire conversation from, is India slowing down, to, are Indian companies losing their pricing power?
And the answer, for right now, is yes. Relative to historical expectations, they are.
So if that money, the almost 20,000 crore net outflow, is leaving direct equities in the secondary market because of these fears about nominal growth and valuation pressure, where is it actually going? I mean, it's not sitting under a mattress.
No, it's not. The data shows a massive and I think fascinating reshuffling of the retail portfolio. It's not a complete flight from money. It's a migration to asset classes that are perceived as either safer or offering quicker returns.
So we're seeing highly active capital looking for better immediate returns.
Yeah.
Or perceived safer havens.
Absolutely. And in this environment of uncertainty, the Indian market is offering two very attractive, high visibility alternatives.
Okay, so let's start with the most fascinating phenomenon, the IPO magnet. This financial year, retail equity flows have behaved in two opposing ways at the same time, which reveals a highly selective approach from the retail investor base.
It does. On the one hand, retail investors pulled out a net 4,729 crore from direct stocks over the financial year leading up to this point.
Okay, so that's the long-term cautious behavior we discussed. They're trimming their positions in existing stocks that they see as expensive or slow-moving.
Right. But the flip side of that coin is this massive, eager investment into new listings. The same retail investors poured a monumental 30,000 crore into initial public offers, IPOs, during the same period.
30,000 crore. That is over 6 times the amount they pulled out of the secondary market.
The magnitude of that difference is just staggering, and it really requires an analysis of investor psychology. This strongly suggests that it is not a total flight from the equity asset class.
No.
Instead, it's a major, significant tactical shift in allocation.
So why are IPOs so attractive right now, especially when the secondary market is struggling with this valuation issue?
It's the pursuit of that quick pop, and the perception that IPOs represent companies with cleaner growth stories or are coming in at better valuations than the overanalyzed existing large caps.
So it's a quick flip mentality.
Exactly. Retail traders are exhibiting that. They subscribe hoping for a massive listing gain, often driven by the euphoria surrounding a new listing, and then once those initial gains are captured, they move on.
And this behavior, while I guess it's rational for the individual, it still dramatically dampens the secondary market flow. That 30,000 crore is capital that isn't being used to buy existing shares on the Nifty.
Right. It starves the broader market of liquidity and prevents prices from rising, which just exacerbates the cool-down effect. It creates a bifurcated equity market, euphoria and high liquidity in the primary market for IPOs,
Right.
versus cautious, subdued trading in the secondary market.
But IPOs aren't the only destination. The data also points to a significant shift to what we call hard assets, specifically precious metals.
The ultimate hedge.
Exactly. It's the ultimate hedge against both market volatility and, crucially, against the low nominal growth environment we are facing.
When low inflation limits corporate pricing power, money seeks assets that retain value regardless of the rupee's purchasing power or corporate earnings growth. And historically, that place is gold.
The sources confirm a massive diversion of household savings. We have specific data from the Association of Mutual Funds in India, AMFI, showing that over 17,000 crore flowed into gold exchange-traded funds, or ETFs, in just the first 6 months of this financial year alone.
And to put that in perspective, that single flow number is roughly 85% of the total money pulled out of the secondary equity market by retail investors in this last cautious quarter.
Wow.
And as the sources note, that number is conservative because Aerophone flows into silver, digital gold, physical bars, and coins would inflate this diversion number substantially higher.
So this migration into metals is not just a safety play. It's also a return-seeking strategy reacting to a specific economic environment.
Precisely. Precious metals have delivered strong returns this year, often outperforming the Nifty 50. For a retail investor whose direct equity portfolio is stalling or whose gains are concentrated in just a few stocks, that return is a powerful, tangible magnet.
Right.
They are shifting assets to where the best immediate returns and safety are perceived to be. It's a very rational response to the threat of low nominal growth. If companies can't raise prices, I'm going to buy an asset that inherently reflects currency value.
So domestically, the low nominal growth fear is causing this tactical rotation out of expensive secondary stocks and into quick flip IPOs and the safety of precious metals. But the Indian market isn't solely driven by domestic money. We have some major foreign headwinds to address next. So it's not just the cautious domestic retail investors. Foreign money is also pulling back, which introduces some significant global factors into our equation, and it adds to the downward pressure on the Nifty 50.
Yeah, the FII story, the foreign institutional investor story, it's a long-standing structural headwind for the Indian markets. And the data shows it's continuing to play out in a big way this year, adding to the liquidity crunch caused by that retail retreat.
Okay, so let's look at the FII flight data. It's compiled by the CDSL. FIIs withdrew a net total of more than 27,000 crore.
Right.
Which is the difference between what they bought and what they sold in the current financial year.
Now, that 27,000 crore net withdrawal might sound manageable, but the context is absolutely critical here. This current flight follows an even more seismic net negative withdrawal of 1.23 trillion rupees in the preceding year.
A trillion.
A trillion. This is not a minor portfolio adjustment. This is a sustained, heavy-handed trend of foreign money de-risking from the Indian market structure over 2 consecutive years.
That is a staggering amount of foreign capital exiting. So what exactly are the global drivers that are spooking FIIs, prompting this continued sustained flight despite the 8.2% GDP growth?
Well, the sources give us 4 key interconnected reasons.
Okay.
The first is simple economics, but it carries immense weight. Stretched valuations, Indian stocks, particularly in the large cap banking, IT, and consumer goods sectors, are just expensive compared to regional peers or their own historical averages.
And FIIs are all about relative value.
Exactly. When the Nifty's forward PE ratio sits significantly higher than that of China or even Brazil, they struggle to justify allocating capital here, especially when earnings growth projections, that nominal number, have been downgraded.
Okay, so that's number one. What's two?
The second reason is purely global. A general flight to safety due to this pervasive global risk-off sentiment.
Right.
When geopolitical tensions are high, or when there's macroeconomic uncertainty about inflation and interest rate paths in developed markets, high-growth, emerging markets like India are often the first place institutional money withdraws from. India represents higher beta risk, and in a risk-off environment, capital seeks certainty.
Okay, and the third one, that seems like a big one.
It is. Third, and this is perhaps the strongest current drain, is the magnet of the ripping U.S. economy. The U.S. market has provided exceptional returns recently, buoyed by the very AI catalyst that India lacks.
So the money's just going where the action is.
It is. When the S&P 500 is hitting all-time highs and offering high liquidity and perceived safety, capital naturally moves. Plus, the interest rate differential, if U.S. rates remain high, it makes fixed income and capital preservation in the U.S. just more attractive relative to the volatility of Indian equities.
And a fourth driver is highly topical and political: trade anxiety.
Yes. There is a palpable fear of a negative year for exporters due to potential Trump tariffs. Large funds that invest in export-driven companies require stable, predictable trade relations.
So the political uncertainty translates directly into financial uncertainty.
It does. And FIIs would rather wait on the sidelines until that political risk is clarified. So when you combine the pressure of high valuations, the need for global safety, the massive draw of the U.S. market, and acute political and trade uncertainty.
You get a powerful cocktail.
You do. It's a powerful cocktail driving FII money out of the country, directly contributing to the cool market.
So we have this double whammy, retail caution and FII flight. Yet the Nifty hasn't collapsed. It's only down to a sub 8% return, not a net loss.
Yeah.
So the sources introduced the key stabilizing element, the local hero, the force preventing the market from being overwhelmed by this massive dual withdrawal.
And that is the domestic institutional investor, or DII, specifically the Indian mutual fund investor, who is religiously using the systematic investment plan, the SIP route. This is the structural anchor of the market.
And the sheer magnitude of this domestic flow is truly staggering. Domestic investors have poured in almost 2 trillion rupees.
2 lakh crore rupees.
Through this structured monthly SIP route this financial year.
And this is the critical piece that explains the paradox of a sub 8% Nifty return instead of, say, a negative 15% return. This massive, consistent, disciplined flow of domestic retail savings acts as an incredible shock absorber.
So it's a buyer base that's impervious to short-term volatility.
It is. They're not worried about nominal growth concerns because their goal is long-term capital accumulation.
So this steady SIP money has been successfully absorbing the persistent, heavy-handed withdrawal of FII money and the recent tactical pullback of direct retail money.
That's right.
So it confirms that while active retail traders are cautious, the long-term, disciplined retail investors, the ones using mutual funds, they remain highly committed.
It really speaks to the structural maturity of the Indian savings culture. This stability means that the long-term fundamental story of 8.2% GDP growth remains intact, even if the short-term sentiment is weak. The market is not collapsing because the foundation is being continuously reinforced by local savings.
So we've identified the headwinds. We've got low nominal growth, this rotation into metals and IPOs, and the FII flight due to global fears. If these factors are temporary, and the structural 8.2% GDP growth suggests they should be, what concrete conditions might reverse the current subdued market sentiment and reignite broad, widespread enthusiasm?
Well, we need to see some fundamental macro reversals that solve both the nominal growth problem and the global anxiety problem at the same time. And the sources give us a pretty clear 3-part roadmap for what policymakers and investors are actively expecting to materialize over the next, say, 12 to 18 months.
Okay, let's start with the most critical expected reversal, the inflation target restoration. As we established that abnormally low inflation deflator, the 0.5%, is the primary constraint on corporate revenues. The market needs this to normalize.
And the expectation is that this near-zero inflation is transient. The government's full-year target for inflation is 2.6%, and the stated target for next year is 4%.
Okay.
If, and crucially when, this expected return to a normal inflation level occurs, it will definitively reestablish the nominal real corridor, as the sources describe it.
So let's explain what reestablishing that corridor means in practical terms for you, the investor.
It means the fundamental valuation equation returns to its historical norms. We would see that sustained 7.5% real GDP growth combined with a 4% inflation component, leading to a much more palatable 11.5 to 12% nominal GDP growth rate.
And that restored nominal growth would immediately boost expected corporate top-line growth.
It would. It allows firms to regain their pricing power and justify their current PE multiples. That is the single most important catalyst the market is waiting for.
Okay. The second expectation is tied directly to addressing the valuation concern. Corporate profitability broadening.
Yes.
The current market situation is characterized by highly concentrated earnings. A few large players are carrying the weight of the entire index.
So the hope is that corporate profitability will broaden out significantly. This means that the economic benefits of that 8.2% GDP growth have to start flowing to a much wider set of industries.
Right.
Especially the mid and small cap sectors that have lagged so significantly. This would instantly address the stretched valuation issue.
Because if earnings start flowing to a wider array of companies, then the high valuations currently placed only on those few top stocks become more generally palatable.
Exactly. And liquidity can flow more broadly across the index, driving overall market momentum. It would signal that the growth story is deepening beyond just the top 20 companies, which is a major factor in attracting long-term, non-concentrated FII money back into the market.
And third, addressing that potent FII anxiety, there is the hope for trade deal comfort. An India-U.S. trade deal is described in the sources as imminent.
Which would be a huge psychological and financial boost. It would immediately calm the nerves around potential Trump tariffs and provide significant comfort to foreign institutional investors about regulatory stability.
So a definitive trade agreement, or even just major progress toward one, would likely precede any massive FII inflow.
It would. It would certainly reduce the incentive for continued withdrawals, marking a real turning point in the FII risk assessment.
And on the topic of global trade, while the FIIs are worried about tariffs, the sources provide a powerful positive silver lining about India's resilience against U.S. tariff threats. Successful trade diversification.
Yeah.
This is a crucial fundamental strength the market hasn't fully digested yet.
This data is fantastic because it demonstrates the underlying agility of the Indian export machine. The recent export data shows that the overall impact of U.S. tariff hits has actually been quite limited.
Right.
Because exporters have been exceptionally proactive and agile in finding alternative markets.
So let's look at two specific examples of this resilience and tactical pivoting. First, take the marine exports sector. The sources show that U.S. exposure has been consciously shaved down significantly, from almost 35% of their total exports down to just over 21% when you compare 2025 over 2024.
And that reduction means they didn't just stop exporting, they successfully rerouted that volume. They found major new markets to absorb that difference in China, Japan, Thailand, Belgium, and Canada.
So that flexibility means that even a major tariff threat from the U.S. would no longer cripple the industry.
It would just force the product to reroute, proving resilience against these political shocks.
Then the gems and jewelry sector shows an even more dramatic example of this pivot. U.S. exports were down a staggering 76% in some categories due to demand and tariff fears.
A huge drop.
Yet the overall export dip for the entire sector was only a negligible 1.5%.
And that minimal dip is because exporters managed to diversify at lightning speed to the UAE, Hong Kong, and Belgium. This highlights the foundational strength, the sheer ability to pivot and find new buyers, which is a powerful structural argument that should eventually reassure FIIs that the economy is anti-fragile when it comes to trade war risks.
This analysis leads us directly to the actionable takeaway. What does this convergence of short-term caution, technical economic factors, and long-term fundamental strength mean for you, the learner, as a retail investor navigating this paradoxical environment?
Well, the sources offer very clear, disciplined advice based on observing the volatility, the specific psychological shifts, and the high tax implications of the rapid asset shifting we've seen with the flight to metals and IPOs.
And the primary warning is against the emotional, reactive, all-in and all-out strategy.
Oh, absolutely.
Making a full portfolio move to cash or precious metals just because the Nifty is cooling off is a defined route to losing money in the long run.
That strategy carries two guaranteed pitfalls. First, you face immediate, heavy tax implications from realizing all those gains in a short period.
Right.
And second, and statistically more damaging, you introduce a very high probability of incorrectly timing your re-entry to the market. When that nominal growth corridor is reestablished, the market will snap back quickly, and you risk buying back in after the market has already moved significantly higher, missing the recovery and destroying your annualized returns.
So if the market correction is healthy and temporary, what is the professional recommendation for retail investors in this environment?
The recommendation is to adopt a highly diversified asset allocation approach. This is the method that allows you to capitalize on the immediate strengths we see, like the run in precious metals and the high returns in IPOs, while maintaining robust, disciplined exposure to the underlying strength of the 8.2% GDP growth.
So you ensure you benefit from the inevitable reversal.
You do. The specific advice is clear. Trim your portfolio on the basis of your chosen allocations, but don't pull out completely.
Trim, but don't pull out completely. That allows the investor to capture some of the gains, meet their specific asset allocation goals, and still be firmly positioned to benefit from the long-term structural growth when the nominal numbers normalize.
Exactly. It respects the fact that we have these incredible GDP numbers pointing to long-term strength, while acknowledging that short-term volatility, driven by nominal growth fears and FII anxiety, requires tactical, disciplined adjustments, not panic.
That brings us to the full synthesis of our deep dive. So to bring all these complex threads together for you, the current cool down in the Indian stock market is absolutely not a sign of fundamental economic failure, but rather a complex collision of short-term technical and behavioral factors.
That's right. We established that it is a result of low nominal growth expectations, which are driven by an abnormally low inflation deflator, significant internal rotation of retail money away from secondary stocks and into IPOs and precious metals, and external FII anxiety driven by general global risk-off sentiment and the specific threat of Trump tariffs.
Yet, throughout this entire period of volatility, the market system is being kept remarkably stable by the massive, consistent flow of domestic SIP money, which acts as the ultimate structural anchor.
It does.
The core tension, based on all the source material we've analyzed today, is the fight between short-term fear, seeing the retail sell off and fearing the tariffs, and the underlying immense long-term economic fundamentals. That 8.2% GDP growth print, the stabilizing DII flows, and the successful, resilient diversification of the export sector. The consensus we draw is that the long-term fundamentals will eventually win once those macro reversals, specifically the return of inflation, play out.
And this leaves us with a necessary and I think provocative thought for you to consider, based directly on the analysis we just completed. The sources clearly suggest that a low inflation environment is profoundly problematic for stock market growth because it suppresses nominal revenue growth.
Right.
We are expecting the inflation targets of 2.6% for the current year and 4% for next year to be met, restoring that crucial nominal real corridor.
But what if those expectations are wrong? What if the inflation targets are repeatedly missed and the nominal growth remains stubbornly suppressed for a prolonged period of, say, 2 or 3 years? What new, aggressive investment strategies, beyond the traditional flight to precious metals, might a rational, return-seeking retail investor be forced to adopt to secure real positive returns in an environment where corporate top-line growth is consistently constrained by near-zero pricing power?
And that's the kind of forward-looking scenario planning that truly separates the prepared, disciplined investor from the one who is simply reacting to headlines. Thank you for joining us on this deep dive.
We'll catch you next time for more essential knowledge.